Hello, and welcome to the quarterly market update webinar. My name is Dan White, one of ARK's associate portfolio managers, and I will be moderating today's call. This call was pre-recorded on April 11th, 2025. Kathy, typically we hand it over to you for some big picture commentary here. That goes right in line with our first question. Just to remind the audience, questions are submitted from our distribution partners, saytechnologies.com, and our Funds X account at ARK Funds. So, Kathy, first question, can you provide us your up-to-date thoughts on the US tariff situation and the state of the economy?
Sure, Dan. Well, as you said at the beginning, this is pre-recorded as of April 11th, and who knows what will happen between now and when this fund update is released next week. But I can just step back, and from the beginning, we have assumed that this president wants a legacy, and he, in terms of judging himself, and even in the last week or so, as the tariff turmoil has hit, he's talked about economic growth and the stock market. Those are the two grades he gives himself. He wants economic growth and he wants a booming stock market. And of course, the tariff, I think, turmoil, for want of a better word, is creating havoc in the markets and in the global economy. And I'd like to think that this is part of his negotiating style. It's not comfortable at all. It seems like chaos theory. But if what the administration is telling us is correct, there are a lot of countries willing to negotiate down to zero and even negotiate on non-tariff trade barriers. Well, if that is what is in the process of happening, then what we are perceiving now as a huge regressive tax increase on the world, with reciprocity, not understandable from the table that President Trump held up last week. Are we really thinking about moving from, wait a minute, this is one of the most regressive taxes in history and is really going to hit the economy hard, to actually a tax cut, or better than a tax cut because of non-tariff trade barriers coming down? I don't know. That's the best case for sure. But we do know, just as I started out, economic growth, the stock market are not in a good place right now because of all the turmoil. And I believe that President Trump is getting, the hard work, from his point of view, done very early on, because he has a lot to do in terms of tax cuts, deregulation, and hopefully influencing, from his point of view, interest rates. So I think what's happening now, just from a macro point of view, even before tariffs, is we are approaching the end of a rolling recession that has been in place since early 22, when the Fed jacked rates up 22-fold. And the ramifications have been one sector at a time. We're putting out a paper on this topic in the next week as well. The two sectors that kept GDP alive during the last 3 years were high-end consumer and the government. Well, high-end consumer is giving way now. A number of companies are saying so, and we see it in the University of Michigan Consumer Sentiment Index. The high-end consumer sentiment has joined low-income and middle-income consumer sentiment down near the lows in 08, 09. And I think on the low-end sentiment, it might even be below 08, 09. So the consumer is not feeling good. We believe, and we've been saying even before tariffs, that the velocity of money is slowing down, and that we're probably in a recession. First quarter, according to Atlanta Fed GDP now, will be down roughly 2.5%. And we think now the seizing up of economic activity around the uncertainty associated with tariffs will probably cause another negative quarter. And interestingly, we started 22 out with 2 consecutive negative quarters, and maybe we end this rolling recession with 2 negative quarters. The other reason we may be in recession is that the government sector is in recession for the first time in 30 years as this administration tries to root out inefficiencies that have grown over 30 years. There's been no cleansing process. The U.S. economy has had a cleansing process, I think, in tech and telecom bust, 08, 09, and COVID. So 3 resets. The government sector has not had a reset. This is a major reset. And we think that it will be a good thing because what has started to happen is the public sector has been crowding out the private sector. So I think that we're going to move now from a rolling recession in the second half of the year, probably to a surprisingly strong recovery once the tariff coast is clear. So we're going to move from a rolling recession into a surprisingly strong recovery, probably led by productivity. And one of the reasons we feel more and more confident about that is during tough times, innovation gains more traction. When consumers and businesses are afraid or concerned, they're willing to change the way they do things. They're looking for better, cheaper, faster, more productive, more efficient, more creative in terms of products and services. And that tends to favor our kind of strategy. And before I conclude, I just want to draw an analogy to the COVID period. So as we were in a bit of shock, much like we are now around the tariffs, in a bit of shock around COVID, the market dropped 25 to 30%. And our kind of strategy was hit even harder. And at the time, what I was saying is, wait a minute, this makes no sense. Who is going to solve this problem? Who's going to sequence the virus? Who's going to figure out synthetic biology so we create the right kinds of tests? Who's going to create the vaccine? Those were our companies. And then, of course, we had a monster move in innovation-based strategies during the aftermath of COVID, during and after COVID. I feel like the last 4 years have been just like that 1 month before COVID. And we've been through, while the market hit new highs, it was very concentrated. That was not a healthy bull market. I think what's going to happen now is that the market is going to broaden out and reward more stocks, especially those who are helping us through this tough situation as well. So better, cheaper, faster, more productive. And we also think what's going to happen here is inflation is going to surprise once we get through the tariff hiccup, if there is one. Inflation is going to surprise significantly on the low side of expectations. And we've just seen that with the CPI and the PPI. And I don't think that's a fluke. We've been calling this for quite some time. So I think we're going to see big surprises, which are going to give the Fed lots of latitude to move in the next 6 to 9 months. And I think a recession in the first 2 quarters will increase the probability that tax cuts, deregulation, and lower interest rates come through. That's going to be a very fertile environment for the market. I know there are a lot of people who are saying, oh my gosh, the recession is just starting now, and it could last through into 26. I don't think so. I think it's ending, and I think the economy will be revving as we are moving toward midterm elections. And this may be even in President Trump's mind. He needs to extend the Republican lead in the House if he really wants to cement his legacy. So I think the shock value of what we've been through, and especially that table of tariffs, which made no sense whatsoever, has created a lot of chaos. But there may be some wisdom in all of this madness, and we will find out in the next few months. So I'll leave it there, Dan, and we can keep going.
Yeah, Kathy. So the next one here is you touch on it a little, but asking it just a little more directly. If tariffs are upheld, reduced, removed altogether, wherever it lands, what is ARK's strategy through this environment, portfolio specific?
Well, during difficult markets, we actually concentrate towards our highest conviction names. And we have been doing that. I mean, in the yen carry trade unwind last year, you saw we concentrated a little more towards our highest conviction names. One of the groups that has been mercilessly hit here is the multiomics revolution. And we are beginning to get more evidence from the FDA. While many think the FDA and all of healthcare services are in disarray, at least within the government, we're beginning to get indications that the FDA is really moving into an innovation mindset with AI. Very important, I think, in the last few days. Again, this was recorded April 11th. We've seen the FDA basically say, you know, in terms of research and discovery, we should stop using animals and start using AI much more aggressively. Now, we would agree with that, and we're positioned for that. But to have the FDA in the middle of this transition, and there are still a lot of transitions in terms of people taking place, to have the FDA come out and start focus on innovation, we think is a very good sign. And we are just so surprised that that particular space has gone nowhere for more than 10 years. In fact, it's a little below, if you, as measured by ARKG, our multiomics revolution portfolio, we are below where it launched in 20, even though the strides towards actual cures and using AI in research and discovery have been enormous. So we think that's the most inefficiently priced part of the market right now. And when we say, of course, we lean towards our highest conviction names, Tesla has been caught up in politics, of course, but also this macro setback. And as you know, we're very focused on autonomous mobility, which will launch commercially in Austin in June for Tesla. So we think that that name, which has been hit by more than half, has also been, we think, unfairly, from a long-term perspective, tarnished in here.
Thank you, Kathy. And for this next one, kind of continuing along here, we'll start with you and then open up to the team. With stock prices as volatile as they have been, what opportunities are you finding in the market?
Well, just like in the COVID period, we believe that our entire portfolio is in bargain basement territory. And the way we know this is we measure our valuation by an adjusted enterprise value to EBITDA calculation that we have done in conjunction with S&P. And on that basis, our valuation is as close to the market as it gets, within 10% of the market, I think, in the last reading, which is roughly where it was around the yen carry trade unwind, which was a great place to, to, again, concentrate towards highest conviction names, but also just generally gain exposure to innovation, especially given what happened right after the election, when investors said, okay, who's going to benefit from this presidency? And innovation stocks did extremely well. And we think they're going to come back in the same way, that first order effect will prove to be the right call once we're through this turmoil.
Yeah, I think to reiterate what Kathy said, when companies face hard times, that's when innovation takes share, because disruptive innovation is always in competition with the status quo. If a company is having to make hard budgeting decisions, they have to forestall hiring. Then they say, hey, can you analysts do more with AI rather than us hiring another analyst or finance person? In the multiomics space, there's a heavy emphasis on government and cutting costs, and we know that the healthcare system is incredibly inefficient, and that it's a big portion of budget spend. And a lot of the companies in the multiomics space that we focus on will deliver cost efficiencies as they get adopted into the market, whether that's a blood test that can detect cancer rather than doing imaging, which is more expensive, and you find out the cancers come back later. So that's the minimum residual disease testing, the likes of which Natera and Guardant produce. Or it's a cure for sickle cell disease, which we'll talk about in a bit, or other rare diseases, which seem expensive because the sickle cell disease cure costs $2 million, but it's so expensive because it gets rid of sometimes hundreds of thousands of dollars a year in hospitalizations and infusions. So it actually avoids costs in the system. It's a cost savings to the system. And that's why, despite concerns early on, we haven't seen the friction from payers in being willing to spend $2 million, because it saves them money over time. And importantly, it saves into a category, into drug spend, that is not going to face the same potential cost inflation pressures that are with the traditional hospitalization system. So we found opportunities, particularly in the multiomics space, which also, of all the sectors, is the longest duration. And so if the Fed, we think, has more leeway here, given what's going to happen in probably the macroeconomic environment, to cut, and particularly because of technological deflation. And if they give relief on rates, these long duration companies in the biotech space that are relying on capital markets to fund operations actually have both an end market that's not necessarily made shaky by a recessionary macroeconomic environment, and cheaper cost of capital as rates come down. And so it's a sector that's not only been beaten down, it also is in an interesting kind of provocative setup relative to the macro environment.
Yeah, I'd like to just put an exclamation point on what Brett said. I think that if you look at the healthcare budget, which is approaching 20% of GDP and ripe for a lot of cost cutting, no question about it, you separate it into therapeutics and sick care. You have therapeutics, depending on the measure, in the 10 to 15% of the budget range. And I think we're hearing more about 10%. And then you have sick care at 85 to 90% of the budget. And you hear the mantra, both President Trump and Health Secretary Kennedy are focused on getting rid of chronic diseases. How do we do that? Well, you cure or prevent. And so that 85 to 90% of sick care dollars can move towards therapies, which could be a huge win for the multiomics revolution. And we think it will be. And we're stunned, actually, that the traditional financial world seems to devalue the idea of a cure. In fact, they don't think it's a good business at all. And Brett and the multiomics team have done a lot of work on just how valuable these cures are going to be. And if you want to see some of that work, it's in Big Ideas 2025 in the multiomics section.
I can just chime in with another example where I think there's a strong divergence between the market price action and the fundamentals, which is in the digital asset space, where we've seen um, as the market's gone risk off, Bitcoin is sold off from its highs above 100,000 to 75,000 at its low, so about a 25% drawdown. And companies operating in this space have been, Coinbase in particular, almost cut in half from their highs. And at the same time, if you look at what's happening, we've gone from a extremely anti-crypto administration in the Biden administration and Gensler in control of the SEC to a very pro administration that's creating a strategic reserve for Bitcoin that just this week confirmed Paul Atkins, who is a pro crypto chair of the SEC. The US Justice Department disbanded their crypto enforcement team. The SEC's case on Coinbase has been completely dropped, as well as many others in the industry. And so that's emboldened. Coinbase believes they can bring potentially perpetual futures contracts to the US, which is a huge market internationally. There's promising bills in Congress for stablecoins, as well as overall crypto market structure. Robinhood is going full steam ahead on their digital asset strategy. So there's a lot of promising developments here. I think one caveat that's Coinbase specific that's probably important to mention is that stablecoins have become a significant part of their revenue. And as interest rates come down, that will be a headwind for them. But it's balanced by likely increasing supply as regulation gets approved and more institutions can hold and use stablecoins. So on balance, I think this is just a place where there's a strong difference in market prices selling off while fundamentals are really improving. That presents a good opportunity.
Thank you, Frank, and Kathy and Brett as well. Brett, I'm going to stick with you here. You mentioned sickle cell. Could you please provide an update on the Casgevy rollout?
Sure. Casgevy is the cure for sickle cell disease and beta thalassemia that I mentioned, and it's commercializing today. It's shared between CRISPR Therapeutics and Vertex. Vertex is the commercialization partner, and CRISPR Therapeutics developed it. This is a gene editing therapy where you take the patient's cells out of their body, you edit it so it can produce normal hemoglobin, and then you re-engraft the blood stem cells into the patient's body so that they begin to produce normal blood and no longer have to have these vaso-occlusive crisis. I probably mangled that vocabulary that cause them to get hospitalized, chronic pain. If you have sickle cell disease, you live to an average age of 50. So this is a really horrible disease, and we have a cure for it now. But the cure is not easy to administer. Really, all in, it seems as if the process takes around 12 months to go from start to finish. So though it's commercialized, revenue has not yet begun to flow in meaningful volumes that we anticipate over the next couple of years. There's a few barriers to commercialization. Because this is a pretty intense treatment, it's almost like a bone marrow transplant. You have to spin up a specific treatment center and train them on how to administer this treatment. You also have to tie together, a supply chain, a cold chain storage to deliver the cells that have been modified back to the treatment center so it can be administered to the patient. And you have to communicate to the patient population and make sure their insurers are on board to underwrite the treatment, which is actually a very good economic deal at $2 million, but it's still something that a patient's not going to pay by pulling out their checking account card. So current status is there are 50 treatment centers that have been spun up. Each of those treatment centers could do, as much as a patient a week as they roll into commercialization. And right now, 50 patients have had kind of their drug. This is as of end of 24, had their cells taken out and begun to be manipulated. One way to think about it is basically everybody, as far as we can tell, that has severe sickle cell disease, that has a matched donor, goes ahead and gets a bone marrow transplant. But only 1 in 5 have a matched donor. Now, bone marrow transplant is just as, and in fact, even more health risky than this treatment, and everybody that has that opportunity seems to do it. So we do think that this cure is going to penetrate a lot of the market over time, and there's plenty of evidence that these companies are gearing up for a big commercialization ramp. Vertex is a very big company, but features it heavily in its conference calls. In late 24, they signed a deal with McKesson to solve the cold chain storage problem. They've ramped up manufacturing, anticipating demand. And, unique to CRISPR Therapeutics, this is the first gene editing company that seems to be able to, as if it will cross into cash flow positive on the strength of one of these cures of disease. So it's not only important to CRISPR Therapeutics, this commercialization ramp, but also for the industry as a whole, as people understand that, hey, a cure where you pull all of the cash flow from patients that would accrue over time up front and get it earlier, and deliver kind of an amazing health outcome to patients is actually economically, not just humanitarianly, a better model for businesses and for bringing drugs to market. People think, oh, well, I want to collect revenue regularly from these patients rather than, curing them and eliminating them as customers. But then you face all the competitive pressure down the road that comes from competing treatments. And then the revenue is out there at year 5 and year 6. We'd rather have the cash flow up front so we can reinvest in R&D and deliver more cures to the marketplace. So that's the update on Casgevy. We're looking forward to seeing, more revenue begin to roll into the franchise, and likely more treatment centers opened, as well as many more patients dosed in this next quarterly update.
So just a couple of other thoughts there. So Casgevy, first to market in terms of a cure, there is this rigorous preconditioning regimen, as Brett said. But in the future, these therapies are going to be delivered in vivo, not ex vivo, not the way that Brett described, like a bone marrow transplant.
Thank you, Kathy and Brett. I think the listeners can hear just how excited we are on that one, and encourage, like everyone mentioned, listen to Vertex too. They are equally as excited about this. Now, shifting gears here into the web team, Frank, this next one's for you. Could you please provide us your updated thoughts on UiPath?
Yeah, sure. So UiPath is an automation software company that's in the midst of a transition, and it hasn't been the easiest. Our thesis for UiPath is that they would be able to use generative AI to expand the number of processes that they can automate, and in doing so, increase their TAM and increase their time to market, or decrease their time to market. And really starting earlier last year in 2024, they announced some execution errors on their sales and go-to-market side, increasing market uncertainty as AI agents or generative AI generally is becoming a buzzword that every company is pitching to executives, and an unexpected CEO transition where Daniel Diemez was taking back the full-time CEO role after just giving up the co-CEO role a few months earlier. And since then, that big announcement, unexpected shift. In October, they announced that they're kind of all in on AI agents. They're reorienting their sales team to act more like forward deployed engineers that are going and working with clients more directly. And they are increasing their product focus to figure out where they need to build out to be competitive in this market that is very competitive. There's tough competition from companies like Palantir, the software giants like Microsoft, Salesforce, ServiceNow are also all in on AI agents, as well as the AI labs themselves. Companies like OpenAI want to deliver more and more capable AI agents and tools to build and leverage AI agents. So that all presents a a lot of shifting sands for UiPath to navigate around. And then now the latest headwind came up in this quarter, which is a slowdown in government spending, which is a big vertical for them. Particularly the IRS is one of their biggest customers, which more or less has paused new software contracts. And so while we will continue to follow the transformation that UiPath is on and the opportunity that they're pursuing, which we think is a big opportunity, and we think they're generally heading in the right direction, it will take a lot of execution to get right and some time to develop. So in the meantime, we've reduced our exposure and exited in several strategies.
Thank you, Frank. Moving to the crypto team. David, for you, what are your thoughts on Bitcoin as a risk-off asset amidst all this tariff news that seemingly is updated every day?
Yeah, so to set the stage with a few numbers and timelines here, over the last 10 days or so, pretty much since Liberation Day, which was April 2nd, on a 7-day horizon, the S&P historical volatility was the highest since COVID, and before that, the great financial crisis, and even matched Bitcoin's historical volatility, reaching between 85 and 90%. At the same time, implied volatility seen in the VIX was not as dramatic and didn't surpass levels seen even in the yen carry trade in 2024. However, the correlation between S&P, NASDAQ, and Bitcoin has been oscillating throughout 2025 between 0.2 and 0.9 for most of the year. As of the time of recording, this correlation is about 0.7 compared to the gold correlation to Bitcoin of minus 0.2. So there seems to be still a link on the way the market is absorbing and trading around the S&P and equities generally, and Bitcoin as well. On the other hand, in terms of giving a sort of timeline of what happened during the Liberation Day and its aftermath, at that point, pretty much just to make the point very clearly, Bitcoin had already corrected quite a bit compared to the S&P. To give you context of that, peak to trough, meaning from all-time high into the lowest since Liberation Day, the S&P corrected 21% versus Bitcoin, which had already corrected 31%. And if we compare that to the movements from Liberation Day, the S&P corrected between 14 and 15% compared to Bitcoin, which only corrected about 9%. So part of this is just the fact that Bitcoin was already like relatively oversold compared to equities, and was already pricing in beyond tariffs an increase in M2 global liquidity. If you track the 21 most prominent central banks around the world, ever since the top in both equities and Bitcoin in late January, early February, global liquidity has gone up from about 104.5 trillion into 108.3 trillion, which is a 3.6 increase. So we believe that that dislocation is already being like absorbing, pricing into the market, and during those sort of tariff panics that we've seen over the last 10 days or so, as of the time of recording. So this is all to say, I think Bitcoin has already like absorbed a lot of the selling pressure and perhaps priced it in a little earlier to Liberation Day. And then from April 2nd and after, the equities were just a little bit more unprepared to digest the news, and have now seemed to go back to some sort of equilibrium to Bitcoin as of today.
Yeah, and David, I guess when I listen to you and focus on your on-chain analytics, they reinforce that the bull market that we have been in for the last couple of years is not over. The internal dynamics are looking good.
Yeah, so 2 points on that in terms of the broader Bitcoin cycle. Usually, what you try to look for when assessing if we're going into a bear market, meaning anything plus a 15% correction for Bitcoin, right? During most likely a year or a year and change. What you look for is two things. One is like some sort of irrational exuberance, a period of irrational exuberance. We don't believe just going into the several on-chain means and on-chain activity and just broadly in the market. We don't believe we saw that even with the price increase from November 5th, the presidential election. In fact, the moves have been quite muted and beyond expectations in terms of just market equilibrium and reduced volatility all throughout 2024 and 2025. So that's one. We haven't seen that. And the other one is just track a lot of demarcation lines that give us hints of the mean reversion of Bitcoin relative to its own cost basis. We haven't seen we have seen Bitcoin return to that cost basis. To give you the specific metric, it's called the AVAV or on-chain mean, which is like an on-chain tracker of buys and sells across Bitcoin. We have seen Bitcoin return to that a little bit, but not break it, which is crucial. And also, what usually happens in terms of realized profits and losses, you see an increment of realized losses, especially from long-term holders during bear markets. And as of now, we are not seeing that type of behavior. So I think as of now, as of time of recording, the on-chain health of the network remains net positive, precluding any other macro events, but so far is within expectations.
Thank you, David. Staying on the crypto landscape, but moving away from Bitcoin. Lorenzo, what are some altcoins ARK finds interesting, again, outside of the usuals, Bitcoin, Ether, and Solana?
Yeah, it's a good question. We've been getting this for the past few weeks, I think, with the price action, and there's definitely been a bifurcation, I would say, in the market between, the majors, especially having more institutional products like the spot ETF, and the rest of the market that has been lagging really in terms of price. We're very excited about several names, and I would kind of mention verticals within the digital asset space. When you look at a lot of the scaling and infrastructure work and developments that has been happening this year with regulatory as well, there's really a very, very different picture for a lot of these protocols that have been in the market for 3 to 5 year, call it. We're very excited on on the decentralized exchange. A lot of the core, I would say, primitives, exchanges, money markets, interest rate derivative platforms, structured products. To name a few, for example, Uniswap, they're now with their 5th version of their AMM. They've been able to deploy that on their own rollup, which is basically their separate blockchain. So we're getting, in terms of latency, throughput, and performance, we're getting close to really centralized venue. For example, for these products, if you look at Binance, OKS, you trade on any of these venues, it's probably around 20 to 50 millisecond latency. This and DeFi and digital asset has been impossible for many years, and now we're really getting closer to that. So in terms of user experience, we think that is a game changer for a lot of these users. And again, I think Frank mentioned it in terms of value accrual. A lot of these projects now can return value to the token holders in different ways, even distributing some of the revenue, buying back their own token and burning it. So on the deck side, we're excited about what Uniswap is doing, Orca on Solana. Aave on the money market side, they've been growing share. So Aave is the biggest money market borrow and lend platform on Ethereum. They've been able to grow, their market share for the past year and a half. Now it's closing in on 65-70%. A lot of liquidity moats, network effects. It's one of the most secure platforms, really, if you want to park 50, $100 million worth of stable coins, ETH or Bitcoin, really any digital assets. And we're very excited about what Aave is doing. A lot of developments in interoperability. They're deployed in many blockchains, and I think this is going to be a very exciting news. They're also working on RWAs now, on real world asset and tokenization, and they're launching Horizon Lab, which is a sub product of Aave, more focused on tokenization, and we're really excited there. I think on the stablecoin side, we've seen this tremendous growth this year. Circle and Tether have done really a tremendous job and have most of the market share, but we really think, passing some of that risk-free yield to the end user at some point is going to be key, especially like in emerging markets where you have access to the dollar and then, you can have access to the 4.55-ish%, depending on obviously whether the risk-free rate is. And I think we're excited about what MakerDAO is doing. We're looking at Athena very closely with different mechanisms, really, to get that yield. Just to finish, like on the staking and liquid staking side, Lido and Jito, we think they have excellent products, very sticky network, both on the validator side and on the user side. If you really want to have the most efficient, I would say, and liquid way to stake your assets, those are definitely the two protocols you would go for on Ethereum and Solana. So yeah, Dan, these are really, we're very excited about these ones. I think more on the protocol layer this year. Monad is on testnet, Mega ETH, which are really kind of revamping the EVM, which is the operating system of Ethereum, and so we're looking very closely at that and very excited. And we like also what Celestia is doing more on the data availability side. Bandwidth. The two biggest constraint, bandwidth and data availability right now for applications. And Celestia is doing an amazing job there. I think the founder post, they're getting to 100 megabytes per blob. They're probably going to make an end of the roadmap. They want to get to 1 gigagas. And that I think is going to unlock a lot of high throughput kind of applications on top of Celestia. So those are really to name a few altcoins projects that we're extremely excited.
Yeah, thank you, Lorenzo. Great perspective of the entire crypto landscape there. Appreciate it. We're going to shift gears now to our last block of questions for the autonomous and robotics team. Daniel, first one's for you. How confident is ARK that Tesla will hit its autonomy goals?
Sure, great question, Dan. ARK is confident that Tesla will hit its autonomous goal. And ultimately, we believe that Tesla's autonomous robotaxi network will represent roughly 90% of Tesla's enterprise value in 2029. And why do we believe this? Well, firstly, in the short term, Tesla has confirmed and reiterated that they will be launching a commercial robotaxi service in Austin this June, as well as California later this year. And we think this will really be a seeing is believing moment for the industry. And what's also driving our confidence is our research. We believe Tesla has an advantage on both the data and cost front. As it relates to data, our research suggests that Tesla's full self-driving is gathering roughly 10 million miles of data from diverse geographic regions per day, relative to Waymo's 200,000 miles per day from its geofenced areas. And on the cost front, Tasha Keeney has done tremendous work here, and ultimately we believe that Tesla's cost per mile can be 30 to 40% lower than Waymo's, thanks to its vertically integrated manufacturing strategy, as well as lack of reliance on expensive sensors and LiDARs. So when you combine both Tesla's data and cost advantage, we believe it should enable Tesla to scale much faster and more efficiently than competitors once it hits the market in June.
Thank you, Daniel. And our final question here is for Sam. So Sam, when are batteries going to scale down on price for residential purchase and use?
I think we're already there. And we're certainly there on the utility scale. So I think people are starting to take note of this. You see Tesla's Megapack sales really soaring, their energy storage deployments continuing to be strong. I think, as with everything, the tariffs and confusion there might slow things down slightly. But the prices we're seeing in China are quite low. Really, in the, I would say, around $50 to $60 per kilowatt hour. And so this is applicable for the home. And again, on the home side, it's much more geographic dependent because of the way utilities price and everything like that. But we're there when it comes to battery cost declines.
Thank you, Sam, and thank you to the whole ARK team. That will conclude our webinar for today. We will briefly show performance statistics that can also be found on ark-funds.com. Thank you to everyone who listened to today's call, and again, thank you to the entire ARK team.